Hello, good day. This is Dr. Don Charles. Welcome to my course, Day Trading Stocks. This lecture will cover fundamental analysis. The outline for this lecture highlights that we will cover fundamental analysis. Fundamental analysis. What is fundamental analysis? Fundamental analysis is the analytical framework which seeks to measure a stock value by examining the related economic and financial factors. So the trader or investor that is interested in the stocks considers the economic and the financial factors which may impact the price of the stocks. The economic factors which may be considered include the GDP, inflation, and employment. These are just some of the covered economic factors. Other economic factors can also be considered. The industry factors which may be considered include the profitability of the industry. For example, in Trinidad and Tobago, the banking sector is profitable. Banks tend to make profits every year. Therefore, a trader or an investor that is considering buying stocks may buy bank stocks, as these should be the stocks of companies that are performing very good. Fundamental analysis also considers the financial factors which reflect the profitability of a company. This includes looking at financial ratios which reflect the profitability of the firm. So this lecture will pay attention to the financial factors which can reflect the profitability of a company. The financial factors which may reflect the company's profitability are earnings, debt. However, stock prices are also affected by the performance of the industry which a company is operating in. So it is affected by industry, it's affected by the state of the economy, it is also affected by expectations and speculation. So we will start with earnings. We will look at the financial ratios that reflect earnings. An owner of common stock has a claim on earnings. When a person buys a stock, they are purchasing a proportional share of an entire future stream of earnings. This can be represented by the earnings per share. So the first financial ratio that we want to consider is the earnings per share. Earnings per share is calculated as a company's profit divided by the outstanding shares of common stock. The earnings per share is an indicator of a company's profitability. So this is the formula here. Note, you do not need to compute the formula. I am just showing you the formula for knowledge purposes. You can find companies' earnings per share on Yahoo Finance or on Finviz. Let me show you. This is Yahoo Finance.
With the storm we are some dry conditions for now that causes building temperatures are warming up.
You can see earnings per share here. This is Finviz.
That's going to help you for our afternoon storm. Stormy at times starting after lunchtime.
We can see earnings per share here. If a company's earnings per share is increasing, it suggests the company is becoming more profitable over time. People buy and sell stocks because they want to make money. When people see a company is profitable, this makes them want to buy the stock. This causes the price of the stocks to go up. So good profits for a company and a positive earnings per share is good for a company. This could cause the price of the stocks to go up. Note, I said the key word is could. I said could because it is not a 100% guarantee. The company's stock could be affected by other factors. Nevertheless, a good earnings per share is a good thing, as it should suggest that a company is profitable and it could pay more dividends and the company's price could go up. Another indicator of earnings is the price earnings ratio, PE ratio. The PE ratio is a valuation ratio. To compute the price earnings ratio, you take the company's stock price and divide it by the earnings per share. This shows you how much the market is willing to pay for a company's stock. Now, if the PE ratio is equal to 1, this suggests that the market is willing to pay the same as the earnings per share for the stock. In other words, the market is paying the fair value for the stock. If the PE ratio is greater than 1, it means the stock price is more than earnings per share. This means the market is willing to pay more for the stock than what it should receive in dividends. Now, I don't want to say that when the PE ratio is greater than 1, that the stocks are overvalued. So I would say the market wants to pay a lot for the stocks. If the PE ratio is less than 1, this means the market is willing to pay less for the stocks than what they should get as dividends. As a trader, you want to trade stocks when the PE ratio is rising, because this suggests that people want to pay more for the stocks. Recall, traders will make money from changes in the price of stocks. So if the price of stocks are going up, then retail traders can make money when the stock price rises. Therefore, a positive and a rising price earnings ratio is a good signal for retail traders. The next thing you want to consider is the dividend per share. This information will be useful to both traders and investors. Recall, investors are the economic agents that buy and hold stocks. They intend to make money from the dividends paid by the stocks over time. Therefore, information about a dividend per share should be of interest to investors. Now, getting into the dividends per share. Dividends are the interest that a company paid on its stocks. If a company is public, this means it has shares available for sale on a stock exchange. When the company makes a profit, it is supposed to pay shareholders a share of its profits. Each shareholder is supposed to receive a share of the profit based on the number of shares that they hold. This share of profit is referred to as dividends. Just because a company made a profit in a year, it does not mean it will actually pay dividends. Sometimes companies keep or retain your profits. They may pay management some management bonuses. So they retain your profits and they use these profits to pay management bonuses. Or they might use these profits and reinvest it in their business. Recall that shareholders are the owners of the company. So if a company is not paying dividends, the shareholders can vote to change the board of directors of a company, who in turn can remove management. Therefore, companies that are profitable generally try to pay dividends to shareholders in order to keep them happy. The dividends per share is a ratio of the total dividends paid by the company divided by the total amount of shares outstanding. It shows on average how much dividends were paid out by the company. The dividends per share should be of interest for investors and stock traders, as it shows what interest you will get from the company. A growing dividends per share means that the investor will get more income from the company over time. So, a growing dividends per share should be good news for a company. A growing dividends per share should mean the company's stock prices should grow over a period of time. And I also want to emphasize the word should, because in real life, things don't always work like how they should. So to see dividends per share, go to trading view. So let's go to trading view. This is trading view. Type in the stocks ticker in the search box. Recall, The ticker is a symbol for the stocks. So type in the stocks ticker. Here we enter the ticker. Then scroll along the page, and this shows you the dividends per share. So if the dividends per share is the number 1, this means on average, a person is receiving $1 in dividend for every share that they hold. If the dividends per share is the number 5, this means on average, a person is receiving $5 for every share that they hold. So the next ratio that someone needs to know if they want to apply fundamental analysis to trade stocks is the price to book ratio. That is the PB ratio. PB ratio. Note, a lot of the content that is being covered in the course today is technical. I learned this information while I pursued my degrees in economics. The courses that I did, which covered this information, were Financial Management 1, Financial Management 2, International Finance, and Investments. I'm breaking this down for you so it will not be too technical. In other words, you do not need to remember how to compute any of these ratios. However, what you need to know is what these ratios are, what they tell you, how to interpret them, and how to find them. This is what I am showing you. So on to the price to book ratio. The PB ratio is a ratio that shows the relationship between a company's market capitalization and its book value. So you may be wondering, what is a company's market capitalization? A company's market capitalization refers to the total value of a company based on its shares of stock. It is the worth of the company based on its stock. The book value of a company's value is the recorded value of the company in its accounting books. So when you look at a company's balance sheet, it shows a company's book value. Note, a balance sheet is a financial statement that shows the assets and liabilities of a company. The assets are the things that the company owns, while the liabilities are the things that the company do not own but uses to run its business. In other words, the liabilities are the things that the company owes. So back to the PB ratio. The PB ratio is computed by dividing the company's stock price per share by its book value per share. To find the PB ratio, go to FinViz. So let's go to FinViz. This is FinViz. Choose a company stock. Scroll along. Right here, you can see the PB ratio. This is the PB ratio. Now, when a company's PB ratio is below 1, it suggests that the market capitalization is less than a book value. In other words, after taking into consideration the value of the company based on stocks and divide it by the value of the company based on its actual assets, you will get a number less than 1. This means that the value of a company based on its stocks is less than the value of the company based on its assets. In other words, the company is worth more than what its stocks say it should be worth. Therefore, an investor can buy this company. They can buy the stocks of this company as the company is worth more than what it is selling for. This should be of interest to investors. So investors should be interested in a PB ratio. The next thing you want to consider is the debt to equity ratio. The debt to equity ratio compares a company's total debt to its shareholders' equity. It is a measure of the extent in which a company finances its operations through debt versus wholly owned funds. More specifically, it measures or it reflects the ability of a shareholder's equity to cover all outstanding debts in the event of a business downturn. You can see this information on Yahoo Finance. You can also see this information on FinViz. So go to FinViz. You can see the debt to equity ratio here. Let's go to Yahoo Finance. We can see the debt to equity ratio here. Another ratio that shows the performance of debt is the current ratio. The current ratio is a ratio of the total current debt to total current assets. So you may be wondering, what is current debt and what is current assets? The current debts or the current liabilities are those debt obligations that are supposed to be paid by the company within 1 year. The current assets are those assets that can easily be converted into cash in less than 1 year. So cash in the bank, savings, inventory, and account receivables are all current assets. Account receivables are sales that a company has already received, but the company has not received the money as yet. In other words, the company sells the product on credit, but they have not received the cash, they have not received the money for the sale as yet. If the current ratio is less than 1, that means the current assets are more than current liabilities. Then the company has enough money to cover its current debt obligations. So in the short term, the company should be okay. You can see this information very easily on FinViz. So let's go to FinViz. Right here, you can see the current ratio. So these are the tools that you need to use in order to trade stocks. These are free tools. You do not have to pay for them. You can use Yahoo Finance, FinViz, or TradingView. You can see charts, price patterns, and ratios upon the performance of these companies. You can also access news on Yahoo Finance. Now, I want to mention that there are different types of stocks. Stocks generate different levels of income. Stocks pay different quantities of dividends to shareholders. So there are different categories of stocks. The first category of stock is a growth stock. Growth stocks are the stocks of those companies expected to grow in sales and earnings at a faster rate than the market average. These stocks generally do not pay dividends. This is because the issuers of growth stocks are usually companies that want to reinvest any earnings that they earn. The earnings or profits are reinjected into the company. This is done to accelerate the company's growth. When investors invest in growth stocks, they anticipate that they will earn money through capital gains. In other words, they expect the price of the stock to increase. So they buy the stocks with the expectation that the stock prices will increase. They do not buy growth stocks to receive dividends. They buy growth stocks with the expectation that the stock prices will rise. Growth stocks have a high price earnings ratio, PE ratio, but low dividends per share and a low dividend yield as they do not pay dividends. The next type of stocks are value stocks. A value stock refers to the shares of a company that appears to trade at a lower price relative to its fundamentals, such as dividends, earnings, etc. Common characteristics of value stocks include a high dividend yield, a low price to book ratio, and a low price earnings ratio. A value stock is a stock that is trading at a lower price than what it should. This is due to market inefficiencies. Note, value stocks are considered riskier than growth stocks due to the skeptical attitude that the market has towards them. Before you buy any value stock, you should perform some market research on a company. Look at its dividends. Look at its dividends per share. How much dividends were paid out by the company over time? Is the company actually paying dividends? Look at the debt ratios. Look at the debt to equity and the current ratios. If when you look at these ratios, it suggests that the company is performing good, but the company still has a low stock price and a low price to book value ratio, then this is a good sign. You can consider buying this company's stock. Do some extra research. Make sure the company is actually performing good. In other words, do some research on the news about the performance of the company over time. If the company should be performing good, yet the market price is still low, and it has a low price to book value ratio, and it has a low price earning ratio, then you can consider buying a stock. The next category of stocks is referred to as income stocks. Income stocks refer to those stocks that reliably pays dividends to its shareholders. Unlike growth stocks, which investors primarily buy because they expect the stock values to increase, income stocks are attractive to investors as they expect the dividends to increase over time. These stocks should have a high dividend per share and a high dividend yield. Therefore, people buy income stocks because they expect to be paid high dividends over a period of time. This is why any investor will buy an income stock. They buy income stocks to earn dividends over time. So when I buy and hold stocks for a few days, I tend to buy growth stocks and I tend to buy income stocks. However, when I day trade stocks, recall day trading refers to the practice when you buy an asset sometime in the morning or buy it sometime in the day and close that trade before the end of the day. That is day trading. So when I day trade stocks, I tend to buy stocks that are going up, so they are among the most active gainers. I also tend to look for stocks that are trading high on relative volume. That is, the relative volume is greater than the number 2. I also look for stocks that have a low float, and the stocks must have a reason to run. In other words, the stocks must have a reason why they are going up. So I look at the news, and the news suggests that the company's price should go up. This is typically information regarding the performance of the company, such as the earnings per share or the dividends per share. Once I have good news about the company, I buy the stock and I try to get off the market within an hour. So I get in on the market around 9:30 a.m. and I try to get off the market between 10:30 a.m. and 11 a.m. However, when I intend to hold a stock for a few days, I consider more factors. I consider the debt to equity ratio, the current ratio, the price to book value ratio, and the price to earnings ratio. So apart from the financial ratios, the price of stocks is also affected by economic factors. The economic factors include the performance of industries and the performance of the economy. The industry factors which may affect the price of a company's stock are the price of the product, the demand for the product, and the supply of the product. Let me give you an example. Suppose we are looking at the oil industry. In the year 2020, the price of oil crashed in April and it went to minus $40 US. This was a historical low. However, from since then, there was a rebound in oil prices. In April 2021, oil prices fluctuated between $65 and $70 US. This was high relative to the past 3 years. Therefore, oil exporting companies should be more profitable in April 2021 than they were in April 2020. So a trader or an investor can buy oil company stocks in April 2021 as these companies should be profitable. If the companies are more profitable, they can pay more dividends and their stock price can increase. This is the kind of analysis you need to perform if you are interested in trading stocks. The performance of a country's economy can also affect stock prices. If a company is performing well, so for example, if a company is experiencing strong GDP growth, then this is a good sign. Companies operating in that country could also be profitable. So for example, the car insurance sector provides insurance for people that own vehicles. So if the economy is performing well, so if the economy is growing, so if the GDP growth is positive, unemployment is low, people have jobs, etc., there should be strong consumption in that country. Then there could be strong demand for cars in that company. When the demand for cars grows, then this causes the car insurance companies to make money since they now have to insure more cars. This can result in the insurance companies being more profitable, and it can cause companies to pay out more money as dividends. This can cause the insurance companies' stock prices to increase. This is the kind of analysis you need to do when performing fundamental analysis. So the last fundamental factor I want to mention in this lecture is emotions and speculation. So if there's a rumor about revenue of a company and revenue slowdown, this can cause the company's stock price to decrease. Likewise, if there's a rumor about potential profitability of a company, this rumor can cause the company's stock prices to increase. Now, the key word I mentioned is rumor. Sometimes there's rumor. Sometimes there is rumor in the sense that this is not accurate information. There's just some kind of rumor, some people spreading information, some news about the company's performance, and people hear this information and they start to react very widely. So when they get good news regarding a company, they start to buy the company's stock and the stock price go up. Likewise, if there's bad news regarding the performance of a company, if this bad news is circulating, this news alone can cause the company's stock price to decline. News can come out regarding a company. If the news is good, the stock prices could increase. However, people can overreact and there could be a large increase in stock prices. Likewise, if the news is bad, the company's stock prices can decline. People can overreact and there can be a large decline in stock prices. This is normal for financial markets. Speculation can cause an overreaction to news. So we covered a lot of content in this lecture. So I will end this lecture here. This is Dr. Don Charles. Thank you for listening and stay tuned for more.